Halo semuanya, saya Fadil, saya mahasiswa di UK. Pengalaman saya menggunakan BNI Tapus Diaspora adalah kemudahan bertransaksi hanya dalam hitungan menit, bahkan hingga ke luar negeri. Ayo buka rekening BNI Tapus Diaspora.
Prosesnya gampang, gak ribet. Aktivasinya pun bisa pakai nomor telepon lokal US. Sukses terus ya BNI.
Halo, saya Eri. Saya bekerja di London, Indonesia. Sebagai pengguna mobile banking BNI, saya bisa lebih mudah melakukan transfer ke Indonesia dengan cepat dan mudah dalam hitungan detik. Ayo teman-teman, segera buka tabungan BNI ya.
The mystical beauty of arts, culture, and heritage, from east to west. We are ready to welcome the world.
Bank Negara Indonesia, aturan perkasa.
Good afternoon, ladies and gentlemen. We are excited to welcome you to Bank Negara Indonesia earnings call of 2023 financial results. We are grateful for your participation and we believe you are well. On this very special occasion, we are going to reveal our latest financial results. But before that, please allow me to introduce BNI directors. First, we have Bapak Royke Tumilar, President Director. Ibu Adi Sulustiawati, Vice President Director. Bapak Silvano Rumantir, Wholesale and International Banking Director. Ibu Novita Widya Anggraini, Finance Director. Bapak David Pirzada, Risk Management Director. Ibu Corina Leila Karnalis, Digital and Integrated Transaction Banking Director. Bapak Sis Apik Wijayanto, Enterprise and Commercial Banking Director. Bapak Putrama Wahyu Setiawan, Retail Banking Director. Bapak Muhammad Iqbal, Institutional Banking Director. Bapak Roni Venir, Network and Services Director. Bapak Muharram, Human Capital and Compliance Director. And last but not least, Bapak Toto Prasetyo, Technology and Operation Director. Our latest corporate presentation is now available. You can download it from the chat room, or you can find it on our website www.bni.co.id, along with other official publications. If our directors present or answer your question in Bahasa Indonesia, we have an English translator. You can simply click the interpretation button on your Zoom apps and then choose English. If you have any trouble, please reach out to our team on our email address ir@bni.co.id. Our CEO, Bapak Royke, will begin the session by discussing our management highlights, continued by Pak Silvano, and then Bu Novita will proceed with our financial performance. Pak David will continue with our asset quality update, and then Ibu Novita will conclude the presentations with our 2024 aspirations. And after that, we will have a Q&A session. And to begin the sharing session, please Pak Royke, the floor is yours.
Thank you, moderator. Good afternoon for all distinguished analysts, shareholders, and rating agencies. Thank you for joining into our full year 2023 earnings calls. To begin our earnings call, please allow me to share some key highlights of BNI full year 2023 results. We closed 2023 with a net profit of 20.9 trillion, or relatively in line with the consensus expectation. Asset quality improvement continued to become key driver to our performance, with credit costs down to 1.4% as a result of sharp improvement in loan at risk ratio, which now stands at 12.9% level, down from 16% a year earlier. All of these are in line with our transformation objective to fundamentally strengthen our loan portfolio in order to achieve superior and defensive ROE over the long run. Last year was particularly a challenging year to negative, especially due to the monetary and fiscal policy tightening, which resulted in the slowest ever growth of money supply in Indonesia. Our low cost of funding grew by 3.6%, which was smaller than loan growth at 7.6%. This condition required us to tap more in term deposit funding. We managed to maintain our CASA ratio at above 70%. Cost of fund increased by 68 basis points during last year, with our exit cost of fund on fourth quarter alone at 2.5% on quarterly basis. One thing I want to highlight here is, despite a tough operating environment, our cost of fund at 2.5% was still better than what we had before the transformation. Back then, it was around 3% level. The structural improvement in cost of fund was due to higher CASA ratio as well as lower pricing on savings and current account, which we believe is the reflection of higher customers' trust on BNI as their transaction banking partner. As we are more than halfway through of our first 5-year transformation program, it is a good time to recap what we have delivered in the past 3 years. We used 2019 as the basis measurement to avoid positive bias caused by low base numbers during the pandemic. Return on equity has increased from 14% to 15.2%, with higher equity base where our Tier 1 capital now at 20.2% versus 2019 level at 18.7% only. Not only how do we achieve higher ROE, but also how we deliver that. As you could see from the slide, we believe our new ROE level came from the high-quality drivers, mainly structural improvement in fee income, operational efficiency, and asset quality. Our ROE improvement in the past 3 years was not as high as what we may expected when we began the transformation. The biggest hurdle came from the lower net interest income, which down by 30 basis points versus 2019 position. A small component of this pressure came from structurally lower risk, lower yield portfolio, which are indeed is part of our strategy. This one is not an issue as impact from risk profile improvement more than enough to offset loan yield pressure. However, the bigger component of the pressure on our margin came from the cost of fund, which we believe that is only temporary and will start to improve once fiscal and monetary policy normalize. Structurally, we have a better funding profile nowadays with a CASA ratio above 70% versus only 65% before the transformation. Despite 3 years of consecutive improvement in risk metrics, we in the management team still receive some questions from the fellow investors and analysts regarding risk of risk of surprise in BNI asset quality. I understand that after many incidents in the past, we need extra effort to gain trust back, and time will tell. There are several angles we are internally keep monitoring. The first one is the big picture of how far we have been shifting our loan book. 3-year CAGR of our loan book was 7.9% per annum, where low-risk corporates and consumer segment drove the growth. Secondly, within watchlist segment, namely commercial and SME non-core (KUR), the downside risk of asset quality should be limited because the majority of our loan book in this segment came from the new booking under stricter underwriting policy. You may see the legacy book is still sizable component here, 30% in commercial segment and 44% SME non-KUR. However, note that these legacy book are of the good quality borrowers as they have survived during the pandemic, and the past 3 years they remain in collectability 1 without involving any restructuring. About 1/5 on the commercial and SME books are already labeled as a loan at risk, and we assign sufficient provisioning coverage for these buckets. Third, we look at RWA density of our loan portfolio, now at 73% versus 82% 3 years ago. And lastly, our risk-adjusted margin continue to get higher over the years. Loan mix shift will favorable for yield perspective, where consumer segment is targeted to grow the fastest among all segments. Corporate segment is expected to maintain its proportion within bank-wide loan mix. Small and middle segment are targeted to grow single digit, focusing on the low-risk borrowers within each segment. And net interest margin should improve toward 4.9%. This assumption is realistic considering the biggest driver in improvement will come from the normalization of funding costs. Internally, we have major initiatives to launch new digital apps for retail customer by mid of this year and for wholesale customer by end of this year. Operating environment-wise, we expect gradual relaxation of monetary policy, which will lead to better liquidity and lower funding costs. Note that 4.9 net interest margin assumption is not aggressive, considering on 2022 we used to achieve that level at some quarters. And before pandemic, our margin was also higher than 5%. Cost to income ratio is targeted to reach 37%, which translates to 10% annual growth in operating expense. Cost of credit assumption remain the same at 1%, with underlying assumption of 1.3% NPL ratio by 2028. This year, we want to focus on frontline employee productivity, which means there will be a lot of role redesign, especially in the branch network level. The next 2 years, we want to focus on building platform that will enhance productivity further, as well as improving clients' experience with BNI. Ultimately, we want to have a superior value proposition to our clients with the best-in-class offering to targeted segment. Now, I would like to pass the presentation to our CFO. Please, Bu Novita.
Thank you, Pak Royke. Ladies and gentlemen, last year BNI grew its loan book by 7.6%, in line with our guidance, with stronger growth momentum in the last 2 quarters. Third-party fund increased by 5.4%, supported by time deposit growth of 10.1%, while CASA grew by 3.6% year-on-year. Interest income increased by 12.5%, higher than loan growth, as loan yield increased by 25 basis points from loan repricing that we did twice, as well as higher yield from marketable securities. Rising competition for deposit has made interest expense to increase by 51% year-on-year, leading to flat net interest income year-on-year. Non-interest income increased by 6.6% with strong momentum on Q4. We will talk the details after this. Operating expense only increased by 2.7% as an impact of strong control in G&A OPEX, which only increased by 2.9% year-on-year. PPOP increased by 1.6% and provisioning charges down by 20%, resulting in 14% growth in bottom line profit. Toward the end of last year, overall non-interest income trend was encouraging, where fee income in consumer banking grew by 10% Q-on-Q, and in wholesale banking grew by 32% Q-on-Q. We expect non-interest income growth this year will be better than last year, probably around 10%, mostly from growth recovery in e-channel fee and marketable securities. Regarding e-channel fee, around 90% of our customers have migrated into BI Fast last year, so we expect no further pressure on the fee this year. While for marketable securities, expectation of a rate cut in the US and Indonesia may provide some tailwind to this fee income item. Our Wholesale and International Banking Director, Pak Silvano, will continue the presentation. Please, Pak Vano.
Thank you, Ibu Novi. Ladies and gentlemen, last year we delivered 7.6% loan growth on a consolidated basis, with the major drivers coming from corporate segment, both private and SOEs, as well as consumer segment. If you recall on our previous earnings call discussing September 23 numbers, one of the excitements there was regarding stronger loan growth momentum after multiple quarters of slow growth due to management focus on asset quality. Now that we believe downside risk from asset quality is minimal and within our visibility, management has been focusing on reigniting the engine. Last quarter alone, we disbursed 99 trillion rupiah of new loans, which was the strongest quarterly disbursement since we started the transformation. After netting off with installments, payoffs, as well as write-offs, the net increase in loan portfolio was 24 trillion rupiah. This was the stronger than this was stronger than the growth momentum in Q3. Private corporate continued to grow solid at 14% year-on-year. SOE segment started its growth trend, focusing on selective top-quality institutions such as Jasa Marga, Bulog, and Telkom. Commercial and non-KUR SME, which have shrunk significantly over the last 3 years period, have finally stopped its contraction and may start to grow at low single digit this year, assuming stable macroeconomic outlook and rational competition in the industry. While on retail banking, we have seen very solid and consistent growth from consumer segment, mainly on mortgages and low-risk personal loans. Last year, retail banking got an additional growth booster from two of our subsidiaries, Hi Bank in SME lending and BNI Finance in automotive financing. One thing that I want to highlight here is that it was not easy to accelerate loan growth while at the same time having to reprice our loan book twice, as well as to increase write-off budgets. On the right hand side of the slide, we are showing the loan yield trend during 2023, which was generally healthy and gradually increasing. Note that in Q3, the yield got several one-offs that we discussed in our previous earnings call. Despite tough competition in certain segments, we always maintain disciplined risk-based pricing, where higher risk segment will have higher pricing. Now, talking about the funding side, the situation was more challenging in 2023 given slow growth of money supply in the system. In BNI, our CASA grew by 3.6% year-on-year, which was slower than loan growth, requiring us to rely slightly more on time deposit, which increased by 10% year-on-year. As a result of limited growth in third-party funds, while at the same time, banking industry loan growth remained strong, we saw a tight competition for third-party funds pricing. Cost of third-party funds on a quarterly basis reached 2.5%, with the major increase coming from time deposit and current account interest rate. We understand that the unusual increase in cost of fund was driven largely by macroeconomic policies. And internally, we have been spending extra efforts to improve our funding structure by increasing customer transactions in our BNI mobile apps and cash management platform. Last year, the transaction value done via our mobile banking apps increased by 75% year-on-year, which we believe is the highest among major banks. To give insights on our asset quality, Risk Management Director, Pak David, will proceed the presentation. Please, Pak David.
Thank you, Pak Vano. Ladies and gentlemen, last year we made another progress in reducing loan at risk book. Now stands at 12.9% of total loan versus the previous year at 16%. Almost half of the loan at risk book came from current restructured book at 5.9% of total loan. This is a significant reduction from 9.7% a year ago. Special mention loan or collectibility 2 was 4.9% of total book. It was higher than the previous year due to downgrade from current restructured loan into special mention classification. Two of the biggest contributors were a textile company and an SOE contractor. Downside risk to our profit is minimum, as we already assigned sufficient provision coverage for these names, 85% for the textile company and 63% for the SOE contractor. NPL ratio improved from 2.8% in December 2022 to 2.1% in December 2023. As part of our conservative accounting policy, we continue to strengthen our provisioning level for watchlist names. We built provision amounting to almost 10 trillion, bringing overall loan loss provision to 47 trillion by end of 2023. Combined with improvement in NPL and loan at risk ratio, the provisioning coverage of NPL increased to 319%. and provision coverage of loan at risk increased to 53%. This is among the most conservative in the industry. Once our loan at risk ratio reaches a desirable level of below 10%, we will reassess the ideal provision coverage level. The balance of COVID restructured book declined almost half to 26.6 trillion, which is equivalent to 3.9% of BNI loan book. Within this amount, the majority was in corporate segment, around 16.8 trillion. We believe the provision coverage is sufficient as the top three names within this corporate COVID restructured book has between 65 to 85% provision coverage. And these top three names represent 3/4 of the corporate COVID restructured book. With the end of OJK relaxation coming to end soon this March, we are confident our overall asset quality indicators will continue to improve this year, thanks to our discipline and conservative accounting policy. Now, Bu Novita will continue the presentation by highlighting our aspirations in 2024. Please, Bu Novi.
Thank you, Pak David. For short-term aspiration this year, we are looking at 9 up to 11% loan growth. We expect commercial and SME segment to deliver a small positive growth versus a contraction last year. We also see strong momentum in consumer segment as we are rolling out automotive financing business, which started to show good progress. Net interest margin is targeted at least 4.5%. We assume cost of fund easing may only start toward the end of this year after rate cut in the US that may allow monetary policy relaxation in Indonesia afterward. We assume room for loan repricing will be somewhat limited. Credit cost is targeted to be lower than last year and gradually heading toward 1% steady state cost of credit from 2025 onwards. I'm going to give it back to moderator for Q&A session. Thank you.
Thank you, Bapak.